Okay. We are going to start this webinar. Hello to everybody. My name is Kamere. I am an advisor within the Secretariat of Making Finance Work for Africa. I hope you are all keeping safe and well in the current uncertain time. It is indeed my pleasure and honor to welcome you to this webinar we are hosting with our partner, Eco.Business Fund. Okay. Hello to everybody. I hope you are all keeping safe in the current uncertain time. My name is Kamere, Financial Sector Advisor within the Secretariat of Making Finance Work for Africa. And it is indeed my honor to welcome you to this webinar we are hosting with Eco.Business Fund and the United Nations Environment Program Finance Initiative, UNEP FI, on the topic Risk and Opportunity from Climate Change for the financial sector. There is an urgent need to put the financial sector at the center of the climate action in Africa. Climate change constitutes a major challenge, posing new risks, but also opportunity for the financial sector. Bank, insurance companies, pensions funds, stock exchange, sovereign wealth fund can play an important role in society adjustment to climate change and contribute to its mitigation. For example, by including climate change and environmental risks in the credit and investment processes, or by incentivizing clients for sustainable investment. The financial sector can also be instrumental in mobilizing private capital flow toward a continent-wide low carbon and climate resilient development investment. So this webinar will discuss how the financial sector can best respond to the challenge and opportunity arising from the climate change. So today we have distinguished speakers from UNEP FI, the Center for Sustainable Finance, University of London, Banco Lafiste in Nicaragua, and we would like to acknowledge the effort of this speaker. She is joining pretty early in the day given the time difference. The session will be moderated by Mr. Eric Wanyama from Eco.Business Fund. Okay, next slide, please. Next slide. Okay, so this is the outline of our session. We'll start with housekeeping, then a quick highlight on making finance work for Africa, then an introduction of panelists, the partner UNEP FI, Finance in Motion Eco.Business Fund, and then the presentations. We have a Q&A sessions that will follow before we conclude. So all that will last around 1 hour and 15 minutes. Move to next slide, please. Okay. For the housekeeping, today's session, as I said earlier, will last for 1 hour and 15 minutes, including the Q&A. And to ensure the high quality of this experience, all participants will be muted. However, questions can be submitted via the chat and the Q&A. You have it on the right-hand bar on the bottom. You can see where you can submit your questions. For live questions, click on the right-hand icon to speak, and then lower your hand and mute. The slide and the recording of this presentation will be circulated within 72 hours if the technology allowed that we can have all. They will also be available on the website of Making Finance Work for Africa. The message to the organizer, you can send your message to the organizer if you're having any experience, any difficulty to interact with us. And please fill out the survey that will appear automatically at the end of this session. Next slide. Okay, as I said earlier, I will share with you some highlights on Making Finance Work for Africa as a good opportunity that you can get to know a bit more of what we are doing. So Making Finance Work for Africa is a G8 initiative in 2008. Our mandate, we are a common platform for the harmonizations and facilitation of financial sector development and knowledge sharings on Africa. So we have as a mandate to bring the donor partner, African governments, private sectors, and other financial stakeholders with the aim of unleashing the potential of African financial sector to achieve the ambitious goal of economic development and poverty reduction on the continent. Next slide. So to achieve these ambitious goals, the Secretariat work along three main strategic pillars, which are financial inclusions, long-term finance, and financial stability and governance. Under financial inclusion, we have a number of thematic, and then on that are like digital finance, SME finance, insurance, but also trade finance. On long-term finance, we have the institutional investor, housing finance, and an initiative they call the African Long-Term Finance Initiative. Under financial stability and governance, we essentially work through the Community of African Banking Supervisor, which is a joint initiative with the Association of African Central Bank. The objective is really to strengthen supervisory framework on banking supervisory framework on the continent. Knowledge management and advocacy is a cross-cutting pillar. Thank you. Next slide. Okay, I would like to acknowledge the contributions of a number of partners that really support the work of the Secretariat, the African Development Bank, the Agence Française de Développement, the German corporations, European Investment Bank, European Union, and the Dutch corporations. Without their support, we will not be able to operate and deliver this program of a webinar. So we are really grateful for their support. Next slide. On that, I will now hand over the floor to the moderator of today, who is Mr. Eric Wanyama. Eric is a senior officer within the technical assistant team of finances in motion. He is particularly in charge of the eco.business development fund. So on that, Eric, you can take the floor and continue with the moderation. Thank you.
All right, thank you, Hughes. Good morning, good afternoon, wherever you are. My name is Eric Wanyama, and I'll be your moderator for the day. Next slide, please. Yeah, so to start off, allow me to just give you a brief profile of the two partners who are working to make finance work for Africa today to deliver this particular webinar. So the United Nations Environmental Programme Finance Initiative, UNEP FI, is a partnership between UNEP and the global financial sector to mobilize private sector finance for sustainable development. UNEP FI has played a significant role in co-creating 3 sets of global financial sector principles to guide the integration of sustainability into financial market practice. These include the principles for responsible banking, the principles for sustainable insurance, and the principles for responsible investment. UNEP FI has also been involved in running the task force on climate-related financial disclosure banking pilots with member banks to help them mainstream and implement TCFD recommendations within their operations. Finance in motion. So in terms of finance in motion, the eco-business fund. The eco-business fund is an impact fund that was established in 2014 with a mission to promote business and consumption practices that contribute to biodiversity conservation, sustainable use of natural resources, and climate change adaptation and mitigation. The fund is managed and advised by Finance in Motion, which is a leading development finance-focused impact asset manager with over $2.5 billion in assets under management. The Eco-Business Fund provides financing and technical assistance to financial institutions and businesses in Latin America and the Caribbean and Sub-Saharan Africa across the following 4 economic sectors: agriculture and agro-processing, fishery and aquaculture, forestry, and tourism. Next slide, please. Next slide, next slide. Next slide. Okay. When it comes to the battle against climate change, the financial sector is unique in that its activities literally traverse all sectors of a country's economy. Consequently, effecting change geared at enhancing climate change mitigation and adaptation within the financial sector can deliver significant systemic and economy-wide gains towards the transition to a low-carbon economy. On the flip side, just as the financial sector has the potential to yield such significant gains, the low-carbon transition effort is just as vulnerable to the risks associated with climate change. Trillions of dollars in financial sector assets are in jeopardy due to these risks. Despite this harsh reality, numerous studies have revealed that financial and corporate decision-making within the financial sector is still largely uninformed by climate and other environment-related considerations. It is imperative that financial institutions get a more accurate picture of the extent of their exposure to climate change risks, develop and implement innovative risk management initiatives to mitigate these risks, and conceptualize strategies that would enable them to capitalize on the opportunities presented by the low-carbon transition. This is at the heart of today's webinar. We will start off by exploring ways in which financial institutions can integrate climate change considerations into their business operations, then proceed to see how banks can use the TCFD recommendations to formulate strategies to take advantage of opportunities presented by the low-carbon transition. We will then conclude with a case study of a Nicaraguan bank that was supported by the Eco Development Facility to incorporate climate change consideration into their operations, and they are now promoting sustainable cattle production. Dr. Ulrich Volz will take us through the first session. The title of his presentation is Integrating Climate Change Considerations Throughout Financial Institutions' Operations, How to Deliver More Sustainable Results. Dr. Ulrich is the founding director of the Center. Next slide, please. Dr. Ulrich is the founding director of the Center for Sustainable Finance and a reader in economics at the School of Oriental and African Studies, University of London. He is also a senior researcher, fellow at the German Development Institute, and honorary professor of economics at the University of Leipzig. Ulrich is a director of the Global Research Alliance for Sustainable Finance and Investment and serves on the Advisory Council of the Asian Development Bank Institute and the Advisory Board of the International Sustainable Finance Center. He is a lead author of a 2018 UN report on climate change and the cost of capital in developing countries, and co-editor of a recently published NGFS volume on case studies of environmental risk analysis methodologies. He was also part of the UN inquiry into the design of a sustainable financial system and has acted as an advisor to several governments, central banks, international organizations, and development agencies on matters of sustainable finance and development. Dr. Ulrich, over to you. Please switch on your camera briefly as you introduce yourself to the team.
Thank you very much, Eric. I hope you can all hear me and see me well. A real pleasure to be talking on this webinar, and thanks a lot to the organizers for having me. So I'll talk a little bit about, set a little bit the scene, why it is so important that all actors in the financial sector get serious about climate change and mitigate macro financial risk, and at the same time also try to develop opportunities for green sustainable investments. Next slide, please. So climate change has very clearly material impact on our economies. Just if we look around, we have almost on a daily basis in news about various catastrophes that are related to climate change, be it severe floodings in France or in Pakistan, or the melting of the Arctic, heat waves in Siberia, and it's getting worse and worse. And this is starting to increasingly have impact on our economies. And it will be ever more important for our leaders in finance to understand these risks and mitigate them. And so there are two main issues. One is, first and foremost, climate change and also other environmental risks like biodiversity loss pose a serious systemic risk to the financial sector. So there are different types of climate-related risks. We have physical risks, transition risks, and liability risks. Physical risks basically relate to effects of climate hazards, but also slow onset effects of gradual global warming that may have an impact on certain economic activities. Transition risks are basically related to in response to climate change. So, for example, carbon taxation can have a very significant impact on certain sectors, but there are also changes due to preferences by consumers, and also technological changes as our economies try to address. And this can have impact on individual companies, entire sectors, and of course, the financial institutions that lend or invest in these. And David, in the presentation afterwards, will talk in more detail about transition risk, which has really received most of the attention in this discussion. Certainly, there's also liability risk. That's basically legal risk related to not taking appropriate caution in addressing climate risk. And it's important really to emphasize that these risks are both at an institutional level, so micro level in the financial sector, but they can also build up to sector-wide problems. And this is why central banks and financial supervisors have started to take this very seriously. Another reason why central banks and supervisors have started to look into this is that climate change can also have very direct consequences on macroeconomic variables and price stability, which is kind of at the core of what central banks in particular are concerned about. And this is also very straightforward. So just to give an example, agriculture is one of the sectors that is most affected by climate change. And so if harvests are affected, this can have an impact on food prices, which then can directly feed into inflation. Energy is another sector which is massively impacted. And we can also see already how climate change and also policy responses have been causing both supply and demand shocks. And these need to be understood if central banks are going to respond properly. So there are good reasons why financial and monetary authorities are now taking note. And this, of course, is also important for private financial institutions. Next slide, please. So, as was mentioned in the introduction, it is of absolute importance that the financial sector plays part in the transition to a low carbon economy. This is also acknowledged in the Paris Agreement, where the goal of aligning financial flows with a pathway that is consistent with the climate goals is explicitly mentioned. And so that in itself should be imperative for all public policy to try to work towards that goal. But what really caught the attention of central banks and supervisors was indeed the financial stability risk. And you know, those of us who've been discussing climate risk for long, we're not had for some time problems convincing central bankers, supervisors really to take this seriously. But this is now firmly acknowledged, and we have an ever-growing number of central banks and supervisors who really start working on this and trying to seek ways of aligning their policies with climate risk. And we have seen the establishment of the so-called Network of Central Banks and Supervisors for Greening the Financial System, the NGFS, which was set up in December 2017 by 8 institutions, and which has by now grown to more than 70 institutions, which shows that really we have now almost in, I mean, really becoming mainstream for central banks and supervisors to look and while there is kind of a lot of the discussions are still going on, there's forming a consensus. And if you could please move to the next slide. So kind of the mandates and also ambitions of central banks and supervisors across countries differ. But there is a firm acceptance that climate change is a material financial risk and that something needs to be done. And I would say there are 4 main areas that are basically being accepted and where solutions are being tried. The first one is that there needs to be clear definitions or taxonomies on of what kind of lending and investment activities we want to encourage or discourage. So there has been a lot of discussion about green taxonomy. Now increasingly we also have discussions about kind of dirty taxonomies of activities that should be discouraged. And importantly, these taxonomies really need to be based on scientific evidence and the actual impact of lending and investment. The second area is we need proper data and information. There is now, I would say, a very firm consensus that we do need disclosure and a disclosure of climate and other sustainability risks across the financial sector. If we don't have disclosure and we don't know where the risks lie, it's going to be very difficult to really deal with them. David, in his presentation, will talk about the TCFD, the Task Force on Climate-Related Financial Disclosures, which has been one of the main initiatives in this area and has really set important impulses. The third area is then kind of based on kind of taxonomies and also disclosure and having the right information, is trying to better understand how different transition pathways could trigger certain outcomes. So climate stress testing has become a really important area of work, both for financial authorities, but also now an increasing number of financial institutions has been working on their own climate stress testing and monitoring frameworks. We've just recently, last month, published a 600-page NGSF collected volume with 36 different methodologies how financial firms and others are trying to analyze climate and other environmental risks. And so this is a really key area, and every financial institution basically needs to do that. And this is also why financial supervisors are indeed looking at not only conducting these climate stress tests themselves, but also possibly requiring financial institutions to conduct these as well. And then example of the just risk weighting in the Basel framework. Indeed, a lot is happening, but supervisors and just flagging Hello? I hope you can hear me again. I think I was cut off for a moment.
Yeah, welcome back to Torich. We can hear you.
So I don't know where it, can you please?
Perhaps you could just continue with the fourth point on integration of climate-related financial risks.
Saying that we have these, there is now this and just moving to my last major slide. If you please. Managing financial risk of what financial institutions should be, and analyzing and pricing risks and acting in a way that they will minimize risk. They are not doing their job properly. But not only that, they are also missing a big opportunity. There is no if we look at the sustainable infrastructure needs around the world, this is a massive business opportunity. And there's also a lot of innovation on hope opportunity investors to be part of that success story. And they need to limit their exposure, reduce their exposure to sectors and industries that are very likely going to be stranded assets, and they need to build their the financial sector itself cannot solve the climate crisis. There are so many things that need to happen. Without the we will not manage to say stop being part of the problem. I mean, we'll have huge amounts
Hello? Dr. Ulrich, are you still with us? Okay, I think we proceed. All right, sorry for the technical difficulties, but yeah, if I could sum up my major takeaway from Dr. Ulrich's presentation is that
I'm sorry for that. I usually don't have these problems, but anyway, I was just basically on picking up. If finance doesn't help the just transition, we will not be able to succeed. Finish here, and I'm very sorry for the technical glitches. Thank you.
No worries, Dr. Ulrich. Thank you very much for your presentation. For me, my major takeaway from your presentation is that climate risk management presents a huge opportunity for the financial sector. And if they're not tapping into it, they're not doing their jobs. Now, I'd like to just remind you, kindly take note of your questions. You could share them on the platform, or you could hold on to them until we get to the Q&A session. But for now, I'd like for us to move on to the next session. And this will be done by David. So David's presentation is on financial sector risks and opportunities from climate change, how to understand, analyze, and translate them into effective strategies. David leads the Tcfd program for UNEP FI. He most recently managed a banking pilot with over three dozen global financial institutions on topics of climate scenarios, climate risk assessments, and climate governance. And he is also a contributor of Forbes, where he writes about climate change and leadership. Prior to joining UNEP FI, he worked as a senior manager in risk and public policy for Oliver Wyman Consulting and in model risk management for PNC Bank. His background is in quantitative modeling and decision science. He conducted research in financial decision making at Carnegie Mellon University and graduated Phi Beta Kappa from Williams College. David, the floor is yours.
Great. Well, thank you for that kind introduction. And as Ulrich was saying in his presentation, I'll talk a bit about some of the structures around climate risk disclosure and assessment, with a bit of a focus on the transition side, although our pilot covered both. So you'll hear a bit about the pilot, as well as some of the thoughts and learnings we've gotten from close work with the institution. So if we go to the next page, please. One of the things that I think is increasingly apparent to many of us, and certainly to a large number of stakeholders and regulators and institutions, is the fact that climate is going to have an impact, whether through the physical manifestations of different conditions, which affect perhaps real estate values, that affect agricultural productivity, which affect overall social structures, to the transition side, how people are moving to a low carbon economy and how that really results in the full and fundamental revision of the things that we have known as a kind of 20th century economy. And so recognizing this really means that institutions across the economy, but financial institutions particularly, need to be primed to adapt and to recognize where climate risks are. If we go on to the next page, please. We'll talk a little broadly about these risks. As I said, most of my focus will be on transition, but I think physical risks in many ways are the ones that are most directly known. And we've worked with Cicero through this past program over the last year. And what I like about this graphic really shows that even if you have something that seems relatively straightforward, there's a variety of things on the right-hand side that can be affected in interacting ways. So it could be that various supply chains are impacted both by physical events, but also by shifts to new sectors and new subsectors. There can be new policies, and those policies can exacerbate activities economically. So realizing that the financial impacts of climate are not just straightforward, but also results from dynamic interactions between these things means that we need to take a keen eye in thinking about it. And one of the ways that that's done is through a systematic disclosure of climate risks. And if we go to the next page, the primary way that institutions have been doing that, and what's become kind of the de facto climate risk approach, is that ultimately the TCFD provides 4 pillars, and these 4 pillars are a way in which we can kind of think, and I think this circle diagram shows it well, of the different levels of disclosure and how we want to make sure that we have a governance approach in place, a approach to deal with climate, both in terms of its risks and opportunities that integrates into our firm strategy, risk management to provide us with the key structures and analytics that we need, and then the actual metrics and targets that we as a firm strive for and that we use to find out about ourselves and about those risks, whether it be across the whole institution or within the assessment of a given client. So if we go to the next page, underlying each of these 4 major pillars that the TCFD has laid out, and that TCFD guidance comes from both the 2017 technical guidance that was provided by the Financial Stability Board, the FSB, as well as that has been supplemented with additional technical annexes, as well as in the annual reports of the TCFD. But within each of these, the message has stayed the same around the specific disclosures that institutions should put forth. And as you can see here, these disclosures really aim to be usable by providing a structured way for a stakeholder to assess how one firm is managing its climate risks, what plans it has in place, what exposures exist. And so as a result, as we move toward better disclosure and more standardized disclosure, we can think about which areas of these disclosures are most in need of continued growth and enhancement. And I think the area that we've worked most deeply on in our program, as well as that is probably the biggest challenge, is the quantification of these risks. I think the risk identification process is critical, but beyond that, to ensure comparability and to ensure just a deeper level of understanding, then what needs to happen is really a specific quantification of those risks using common scenarios. So if we go to the next page, in the program that we ran, one of the things that we worked on was looking at the diversity of climate scenarios that exist and recognizing that across a variety of scenarios, we can have key assumptions around energy, around economics, that will have meaningful changes in the level of pressure faced by an institution, as well as what the ultimate losses would be. So we were using approaches that we had developed over the course of the past couple of years with a series of partners to make these assessments. But fundamentally, the importance of multiple scenario analyses to look at different assumptions is really critical. Similarly, we looked into then the methodologies themselves and recognizing that one-off analyses aren't sufficient. We need to be thinking in a comprehensive manner about multiple sectors. So what are the high-risk sectors? How are we dealing with them? And in our forthcoming work to be released next week, we'll provide a transition risk heat map that the group of institutions has discussed and thought about as far as where transition risk resides within the current economy. And then finally, all of this is important, but it needs to be in the public domain. And so what do good disclosures look like, and how do you take those disclosures and drive them beyond just the written page and into practice? And so a couple weeks ago, we released the Tcfd Playbook with the Institute for International Finance, and that was a particularly important step for us in really providing more structure and more guidance around how financial institutions should be thinking about their disclosures. So if we go to the next page. I've mentioned a few of these outputs already, but the work that we've done recently has been to put forth a blueprint for assessing physical risk, a series of transition papers that will be forthcoming, as I've mentioned, looking at climate scenarios, looking at practices around disclosure. We've created a web tool that is freely available to any UNEP FI member to use and evaluate about 15 different climate scenarios from 2 of the leading climate modelers that are part of the NGFS program to develop their reference scenarios. And then, as I mentioned as well, we're working on continually improving disclosure practices and guidance around those. So these are the areas that we've been working on, but I think across all of them, if I had to point out threads in this work and in the future work, what I would say is the goal is to quantify, to make comparable, to standardize, and to make actionable the outputs and insights that are generated, because only then can we actually move and motivate finance to play this important role that it has to play. So if we go to the next slide. To talk a little bit about the look ahead at our upcoming pilot work to begin at the beginning of next year, our vision is to really push people along the road to climate disclosures and help them by starting off with a core curriculum. So understanding climate risk, understanding climate scenarios, understanding assessment methodologies, and making sure that everyone in the program can develop a knowledge and expertise from that. But we've also recognized that that alone is not going to be kind of at the leading edge. And so the way that we've really thought to reposition our work is to take advantage of our convening power to pick these specific topics. You see many of them in gray here, specific topics where institutions can say, this is a topic that's most valuable to me, that is most interesting to work on, and then partnering them with a leading research institution, with a group that is thinking about these and working toward these ideas. And these are really the objectives that, that we have pretty strongly to work in a more nimble module or tract-based approach, with the idea that we want to produce not only thought leadership, but also continued frameworks and tools. So if we go to the next page. So I guess, yeah, so just to conclude then, yeah, I thought there was just a thank you or something at the end, but I must have cut it. But anyway, just in summation then, what I'd want to say is, looking ahead, I think it's our vision as UNEP FI to be the convener and be the place where institutions have these interactions, have these output-driven objectives, rather than just thinking about a program as a passive learning opportunity. But if I get back to what I said previously, as far as themes and as far as challenges, I think that we see a looming threat from transition risk. And I think that that is one of the big motivators for some of the regulatory moves recently toward increased disclosures, toward exploring stress testing. And I think that there's many avenues by which a collapse in a major sector or a disruption in supply chains can create contagion and cause this problem. So while we often think about climate in the physical context, I would also advise you to think about short-term risk in a broader economic sense. Obviously, short-term risk exists anywhere where there are extreme events and anywhere where there are substantial climatic changes, but to recognize climate isn't a 2050 problem, it's a 2020 problem. And some of the ways that can be made manifest can be done so a lot quicker than we may expect. So anyway, thank you again for the time here. I'm eager for our Q&A session in a little while, and I'll hand it back to our moderator.
Well, thank you very much, David. Now to cap it off, I would like to invite Rosaura Salter to present a case study of her bank, Banco La Fisiban Centro, and how they incorporated climate change considerations into their operations and are now promoting sustainable cattle production in Nicaragua with impressive results for forest conservation and sustainable land use. Rosaura is an economist by training and holds a master's degree in international economics from Brandeis University in the US. She has more than 15 years experience in banking, specializing in structured finance and green credit lines. Rosaura is the Vice Manager Social and Environment Program at Banco Lafisa Bancentro, where her responsibilities include promoting sustainability and eco-creditors financing focus on renewable energy, energy efficiency, and cleaner productions throughout the entire Central America region. Welcome, Rosaura.
Thank you very much. Hello to everyone that's present. Here it's good morning, over there it's good afternoon. I'm thankful for the invitation to be here to show how our experience has been with Eco Business Fund and how it has helped transform how we do business in Nicaragua and implement sustainability practices in our loan operations. If I could have my slides, please.
Rosaura, there seems to be some technical difficulties. Just a minute.
Yes, Eric, sorry to intervene, but we actually have severe power cuts here in Abidjan, so we're having some severe technical difficulties. We'll try to get the slides back up. Apologies for this again.
All right, thank you.
Okay, certainly. Okay, I'll just start talking and then we'll show the slides.
Right.
Banco Lafisa is part of the Lafisa Group. We have a presence in 11 countries across the American continent, and 100% is owned by Nicaraguans. We have over 35 years of existence, and we have more than 4,000 employees in over 195 branches spread in all the countries we are present in. Thank you very much. Our group assists our clients in diverse solutions for their portfolios, leasing, factoring, warehouse, insurance, escrows, among many others, by investing in our digital experience. For Lafisa, next slide, please. Next slide. Thank you. For Lafisa, we are a financial group that is funding productive projects. That means we have a large commitment to our environment, our clients, and our community. Banco Lafisa is strongly committed to financing the agricultural sector with a long track record in the largest local loan portfolio in cattle. Part of our solutions for the agricultural sector are equipment insurance, of course, banking, and agricultural stock exchange, eco credits, techno leasing, sustainable cattle farming. That's a new initiative. Next slide, please. Banco Lafisa has had the privilege to work with Eco Business since 2017 and have successfully established 2 technical assistance projects. Together with a fund, Lafisa has prioritized its sustainability approach that was related to its core business, loans, and the first technical assistance project was a custom-built ESMS for our loan portfolio, and the second is sustainable cattle farming, which I'll be giving more details in a short while. The core business of any bank is loaning money at an acceptable level of risk with an optimal financial return. When we look at Lafisa's core business, our material issues were focused mainly on credit, operational, IT, continuity, and market risks. It didn't take into account our social and environmental risks that were inherent to our portfolio. Eco Business assisted us in identifying an ESMS to become operational and practical. Next slide, please. Where the procedures would be focused on simplification and automatization. It also includes a thorough capacity training to Lafisa staff on identifying and evaluating ENS risks. Our ENS system is called SARAS in Spanish. It's Sistema de Análisis de Riesgos Ambientales y Sociales, which is mostly known in English as ESMS. We had an excellent consultant that was hired. Their name is Sitawi, and they're based in Brazil. Thanks to the TA project, which we had with Eco Business, they paid in full the amount of our consultant. And this consultant has an ample experience in SARAS in the region. And it was very interesting because we had a contract between the 3 of us. So that way Eco Business never left us alone in this project. And we always had their help through the TA assistance office. With them, we were able to develop an environmental and social policy based on the best practices of the region. And we had it developed during an 18-month period. This had risk categorizations, classifications, guidelines by the industry to identify the principal risks and opportunities on each of the relevant sectors. We also had guidelines on how to make decisions according to identified risks, and how to support the activities of the loan officers, what documents should be revised, what type of questionnaires we needed for due diligence. All of this that had to be considered while we were visiting the client and while we were presenting it to our credit committee. Citawi developed as an Excel tool, which Lafisa later integrated into its systems. And we had the opportunity to integrate IFC performance standards along with numerous national and international social environmental requirements. Citawi develops materials for training, and they provide sessions to the ESMS working group, to the directors, to the top managers, to all the people that are involved in the credit process with the client. Because of this, Lafisa has been able to comply and exceed all international and multilateral financial institutions' social and environmental requirements. And I strongly recommend that banks should partner with entities as eco.business, whose technical assistance addresses this specific need. Many challenges can occur. Next slide, please. Many challenges can occur in the implementation of the ESMS, such as, well, the prioritization of an employee's time, because our core business is lending money and solutioning our clients' needs, and not necessarily a bank's core business is environmental and social. I think one of the best takeaways we had is that if your ESMS is not intrinsic to your loan cycle and it's a purely based paper system, then there's very large chances that your employees will not be using it. It has to be client friendly, and we have to think about that our employees are internal clients, and we should have it, the digital experience as good as we have with our external clients. Obviously, the benefits outweigh any shortcomings in that a bank, one can anticipate ENS in future clients, as is what are the current labor permits. We can find what are the environmental licenses and other documentation requirements that our clients must complete. If a bank is aware of these risks and how to mitigate them, then they will be better prepared in emergency situations such as spills, explosions, and such. Next slide, please. Cattle production is a key agriculture activity in Nicaragua. It makes up 40% of our agricultural GDP, and considering Lafisa, we're responsible for 50% of the local banking financing of this activity, so it's very important to us. 75% of the cattle slaughtered in Nicaragua are in industrial slaughterhouses, and the remaining 25 are in municipals. Usually marketeers buy them cheap and thin cattle and then fatten them to increase their volume. Companies also buy cattle. Lafisa is involved in every single stage of the cattle industry, and the best market and destination for Nicaragua's top quality meat is the United States. The sustainability field is very large, but you learn very quickly that if you Google cattle farming, you see that there are very alarming results. And many times cattle farming is considered the number one cause of deforestation worldwide. So that was a bit of a problem that we saw, that we wanted to maintain ourselves in the industry, but at the same time comply with international standards. So together with eco.business, we made a project based upon World Bank guidelines, and we gave it a shot to make sure that our clients' cattle production was sustainable in the largest way. So we identified, of our 700 clients, we identified 113. We did mapping. We created polygons with GPS points, all on foot, because we don't use drones in my country. And with them, we saw that we were not in nationally recognized protected areas nor buffer zones, such as Bosowas and Indio Maíz. And we considered a 2010 baseline, so 2010 to 2019. And we saw 17,568 hectares. Next slide, please. Here we can see a bit of, this is the map of my country on the left, And this is a polygon of one of the many cattle clients that we have there. And we saw that 72% of our clients had a maximum of 2% forest change, in total 245 hectares. And with this, we saw that really there wasn't that much of a deforestation in our clients. And this was an opportunity for us to identify our best clients and to assist those who had more deforestation than what was the threshold that was permitted for ourselves. And we also were able to conduct a comprehensive sustainable practices survey. And we were able to identify how silver pastoral systems, animal breed silage, and organic fertilizer were being used amongst our clients. So considering that we finance every single step of the cattle growth, we saw for sustainability through protection of existing natural resources, fomenting tree cover and pastures, and increasing productivity per unit area so as to decrease the need for additional land for pastures. Next slide, please. And this has been very, very interesting because this has opened up an opportunity to have a type of conversation that not necessarily was being done in previous years. We could be identifying what works and what doesn't work among our clients and how productivity results can differ based upon the sustainability practices that were adopted. Fortunately, many of our clients were already implementing some form of sustainability practices, and our strategy focused on consolidating and helping those neighbors of our clients whose productivity is not at the same level. And LAFISA was able to see how the most effective environmental and social actions in these cattle ranches many times are simple and very effective. There were clients who were protecting their forest reserves, knowing that water is generated from and dependent on these forest reserves. This considering that meat and cattle are one of our top 3 exports for Nicaragua, being a $500 million market for us. So you can have a little bit of context. Next slide, please. Due to the climate in Nicaragua, we have 2 seasons, a dry season, November to April, and then a wet season, May to October. So then this forces cattle farmers to have a very good investment in preparation of food reserves for the dry season by improving productivity per unit area in regards to feeding. Our cattle farmers are usually 2 to 4 acres with 1.5 cattle per acre. There are very few large cattle farmers, and in spite of that, we have approximately 6 million cattle in our country, which is basically the same as our human population. Our average dairy output is 2 liters a day, which is one of the lowest in the American continent, and we are struggling to improve these numbers. Next slide. And with this, I just wanted to thank you all.
All right. Thank you very much, Rosario. Now we would like to get into the Q&A session. Please take this time to list some of the questions that you have for the various panelists, and I will ask them in turn. So as that goes on, I could start off with a few questions, and perhaps the first question would be to Rosario. So what tips would you offer to your banking peers in sub-Saharan Africa that want to get their clients to adopt more sustainable practices? What has been your experience?
Well, first of all, you have to identify what are the industries and the sectors which you are a champion in. And from there, you have to start working. Once you identify those industries or those sectors, then you have to go and find your model clients. The best way that you can find this is that you have experts in the field. Many times the people who are in the office, the loan officers, the credit officers, are not nearly that industry savvy in the day-to-day practices. For us in LAFISA, we have 21 technical officers who are in the field and looking each and every farm that our clients have to make sure that the day-to-day business is working. Once you have identified them, they have to be model clients. And many times these model clients are more than happy to be showing to their neighbors exactly what are the best practices that they have been implementing and how they can be easily copied in their neighbors. So I think it's more of a relationship that you have with your best clients and how these can be helping the rest of your clients to be able to achieve these type of productivity results. Another thing is you have to really know what is sustainability and what productivity results are the best for you. You can't compare yourselves to other countries. You have to work with the reality of your country, and from there try to work on. And the third recommendation, which is something that has helped us, is you have to have a very, very strong funder that works with you. It's very easy for many funders to give you credit lines, 10, 15, 20 million dollars. But another very simple thing that is working for us is this technical assistance. This technical assistance is guiding you with your hand, ensure that you're implementing the projects in the best possible way and using those funds at their optimal level.
All right. Thank you very much, Rosario, for that. The next question is to David. Why, in your view, have banks and other financial institutions been slow to adopt and implement the recommendations of the TCFD? And what can be done to incentivize them to take bolder steps towards implementing these recommendations?
Thanks. That's a really good question. And I would say, on the one hand, maybe as a little bit of a push back on it, I think that a large number of the supporters of the TCFD have been financial institutions, and we are seeing impressive uptake from those institutions in making their climate disclosures. However, I would say two things that are particularly important. First, as numerous studies, both from the TCFD Secretariat itself, as well as from other independent academics and researchers, disclosure alone is not sufficient, and current disclosures are not yet providing the level of detail and information that stakeholders need to make decisions about the climate risks of these institutions. And so, as far as that goes, moving that process along faster is both a learning process, but it's also one that responds to market and regulatory forces. And so I think as you're seeing more jurisdictions mandate TCFD, as you're seeing more of an emphasis on public disclosure from the supervisory space, I think that is going to play a really important role, not only in getting the quality of disclosures to continue improving, but even in providing a standard way of doing it. So I think that that's super important to ensure that regulators keep their eye on the ball and keep pushing forward with the recognition that climate risk is a financial risk. On the second piece, I think institutions themselves have a lot to learn and a lot to benefit from doing these types of analyses. And I think at present, climate has not necessarily had the scale and immediacy for financial institutions that it really deserves. And I think the savvier institutions are ones that are beginning to think about how does climate interact and interplay with other risks? And in doing so, what are the ways in which we can be better about understanding the needs of our customers to help transition them to low carbon economy roles? What are the things that we can do as far as screening our existing portfolios and our future strategy? So to me, understanding this is like understanding any other kind of risk. The people who do it best, the people who have the greatest discernment, are going to perform the best. And speaking specifically about banking, but it's, I think, true of the financial sector, this is a low margin business. We need a lot of capital. And so you can't be losing that capital. And those who are able to have a better understanding of the future and of future consequences as well as opportunities are going to be the ones who are more successful. And so, you know, to close on that, similar to the quote from Mark Carney that I opened on, I think the regulators have a big role to play, but I think institutions that do this will do it out of their own recognition that this is material, and those who get caught unawares will feel the consequences thereof.
Right. Thanks for that. Just as a follow-up, could you comment on the level of engagement from the financial sector in sub-Saharan Africa on TCFD?
Sure. So I would say we've seen a lot of really good engagement from South Africa in particular. For other institutions in sub-Saharan Africa, I think there's a growing interest and growing recognition that many of the physical effects may be the most immediate concerns to them. And that's completely in fitting with the climate science, which suggests that these are regions that will be most likely disrupted and affected by the earliest impacts of climate, and ones that we're seeing even today, whether it's agricultural land, whether it's flooding. And I think that recognizing that, especially when those risks affect your customer or client base, is particularly important. And so I see a growing interest. As far as engagement, I see it as a build-up, and one that is continuing to take time, and will need to kind of be met with bringing in the right people to the institutions and making serious views about how does climate fit into our strategy, and how are we going to make that commitment explicit, and how are we going to do things differently because of it. But I think the hopeful sign I've seen is in the interest and awareness, both from the number of webinars like this that I've engaged on over the last few months, to a number of other facets, just from institutions reaching out to learn more about disclosures in the program.
All right, thank you, David. Dr. Ulrich, what would you say are some of the low-hanging fruits for central banks and supervisors that want to start tackling climate-related risks within their financial sectors?
First of all, I would say that central banks and supervisors have a lot of convening power. Supervisory authority are really vocal about the importance of addressing climate risks. This alone can have an impact, and so the supervisory authorities really need to message across in the financial sector, urge financial institutions to capacities for analyzing these risks, and also give some guidance. So, but of course, would not be enough. There are a couple of things that are urgently needed, and we are very straightforward. So, David, disclosure. This is what has to happen, because without I would say making disclosure of climate-related financial risk mandatory would be an important element, and this is pretty straightforward. And of course, you have to give institutions time to adjust it, but we don't have an awful lot of time, really. So the risks are high and the stakes are high, but making disclosure mandatory would be an important element. Also giving guidance on what is green, what is not green, are being developed now in different places, and so there's a lot to draw on. And at the end of the day, supervisors need to demand from financial institutions that they analyze these risks and act accordingly. Of institutions to explain how they are and but I think it has to be a big pack. It's not just individual small actions that will do.
Hello, Dr. Ulrich, are you still with us?
Yeah, I did. my answer. I mean, I can continue, but I saw in the time.
Yes, sorry, we're having technical difficulties. We didn't hear everything you mentioned, but I think you covered the major points on making climate-related disclosures mandatory, and also fast-tracking the development of the taxonomy for sustainable finance.
Yeah, and I was basically saying that central bank supervisors need to use their convening power to really get the message across and demand that senior management of financial institutions engage and explain how they are going to tackle the climate challenge.
Right. Thank you very much. Yeah, do we have any other questions from the other panelists? Perhaps either David or Dr. Urich, you could comment on this. What would be the place and role of the insurance sector with regards to these climate-related risks?
So, yeah, I'll just say a few words. And I know one of my colleagues is leading an ongoing pilot for insurers around climate. And I think that the insurance sector has a tremendously important role to play because many of the activities that contribute to emissions are only economically viable if they're insurable. And as a result, there's a pretty powerful role that they play there. On the more analytical side, I think in a lot of cases, especially on physical risk, insurers have the greatest set of data available, and it doesn't necessarily mean that we don't need to make adjustments to it because it is, of course, backward looking. But when we talk about granular risks, especially on real properties, the insurance industry is really a wealth of that information. And so I see both a role in the actual facilitation of decarbonization, but also in the risk assessment. And I think it's critical that that insurers, take up both these challenges.
Adding on that, I'd also like to emphasize that closing the insurance gap is really important as a way of adaptation to climate change. So a lot of the risks are not insured, and there definitely is a strong case for trying to develop more insurance. So, for example, in the agricultural sector, but also other areas. But at the same time, it's also clear that some risks related to climate change are not insurable because they are just too high. This problem, because who need insurance are less likely to get it. And there are some there needs to be a public sector, kind of public subsidy element in there in many cases. But I would definitely say that also from a financial governance perspective, there is a strong case of trying to help develop insurance-based solutions. And these often, for example, could involve fintech, so kind of newer approaches that can process data in a better way.
All right. Thank you, Dr. Urich. Thank you, David. I think that brings us to the end of this webinar, and I'll hand it over back to Hughes to close out the session. Thank you. Hughes?
Okay, yes. Thank you, David, for the excellent moderations. I will start, first of all, to apologize for the technical glitches that we have encountered. It's very unusual that we face such a level of disruption on our platform, but as you heard that the weather conditions in Abidjan are not the best that we can expect, and this is certainly, this with climate change. Let me thank all the participants who has stayed connected all over this the webinar despite these difficult conditions. Let me thank the panelists for the excellent presentations and the insight that they have shared with all the audience. I would like to thank you, David, again for the excellent moderation of this webinar despite the difficult conditions. There is clear indication that Africa financial sector need to support the drive toward climate resilient and low carbon development on the continent. Improving the understanding of climate-related risks and opportunity is essential, as well as an engaged financial sector in addressing the vulnerability of the continent to climate change. Making finance work for Africa would like to take a more productive and proactive approach in promoting the climate change agenda in the financial sector, focusing on advocacy and knowledge sharing and dissemination in the future. So we are eager to build a fruitful partnership in this endeavor. And I take this opportunity to inform the participants that we have continued to work with our partner, and we have in the pipeline another webinar that will focus on bank as agent of biodiversity. So you will receive the information in the future. So with the technology difficulty that we are having, I will not be very long. I would thank you all for joining this webinar. Just to reiterate that the recording of this webinar will be made available in the course of next week. We said 72 hours if the technology allowed. And finally, when you will leave the platform, there will be a survey that will pop up automatically. We will be grateful if you can fill in the survey. That helps us to improve the quality of our webinar going forward. Stay safe and bye-bye.
Bye-bye.
Bye. Thank you, everyone.